What if the technology that was supposed to make financial decisions smarter ended up repeating the same old mistakes of the past? Artificial intelligence is now being used in mortgage underwriting, property valuations, and credit decisions. But the systems powering these decisions are trained on data rooted in decades of discrimination, inequality. In this video, we're diving into a question that could determine the future of housing access in America. Can AI Satu be trained to eliminate bias in mortgage lending, or will it just reproduce the injustices of yesterday on a bigger scale? Whether you're a home buyer, a tech enthusiast, or just curious about the future of finance, this story matters. How AI entered mortgage lending. In recent years, the mortgage industry, long criticized for slow, manual processes, has increasingly turned to automation and artificial intelligence. Ataka Satu now helps lenders streamline loan processing, automate property valuations, and evaluate credit risk more efficiently than ever before. In theory, this should make lending faster, more accurate, and less prone to human error. But there's a catch. While AI2 can accelerate decisions, it doesn't automatically eliminate prejudice. In fact, if the data used to train the algorithms reflects historical discrimination, then AI2 may simply amplify those patterns, sometimes even more subtly than humans ever did. Understanding this begins with recognizing the legacy that shaped American housing policy, especially redlining. The legacy of redlining and structural inequality. In 1968, the Fair Housing Act legally ended redlining, the discriminatory practice wherein non-white neighborhoods were systematically denied mortgages and financial services even if residents qualified financially. While redlining was outlawed, its effects didn't disappear. Decades of exclusion have led to deeply unequal access to credit, homeownership, and wealth accumulation, especially for Black, brown, and lower-income communities. Today, the homeownership gap between Black and white households remains alarmingly wide, in some ways even larger than during the era when redlining was still legal. This history matters because the datasets used to train AI UAD are built on years of mortgage records shaped by discriminatory practices. If the data itself carries bias, then AIE trained on it may learn the wrong lessons. Why AI can repeat bias? A central figure in this debate is Michael Akinwumi, Chief AI Officer at the National Fair Housing Alliance. He explains a key insight about AI Satu. AI Satu is like a mirror. It reflects the patterns present in the data it sees. If historical mortgage data underrepresents certain communities or penalizes them due to factors tied to discrimination, AI models trained on that data will reflect those patterns, potentially reinforcing inequality rather than reducing it. There are two main sources of bias in AI Satu. Bias data. If the input reflects historical discrimination, the output will too. Algorithmic bias. Even if data were neutral, an AI model doesn't inherently understand fairness unless told how to define it. That means fairness doesn't happen by accident. It has to be programmed in as a core objective of the model itself. Designing AI for fairness. The good news. So, can AI be trained to be fair? According to research led by the Urban Institute, the answer is yes, but only if fairness is intentionally built into the model design. In one study, researchers teamed up with Fairplay AI to create machine learning models designed to optimize for both fairness and accuracy simultaneously. They developed a methodology called distribution matching, a technique that ensures model predictions for protected groups are statistically similar to those for control groups, all while maintaining accuracy. This challenges the common belief that fairness and productivity are mutually exclusive. Instead, the researchers showed they can coexist in the same model. Beyond fairness, smarter predictions for inclusive lending. Another company tackling bias is Greenlane, a fintech provider building AI lending tools with inclusion as a central design goal. Instead of just replicating past credit scoring methods, which often favor borrowers with long credit histories, Greenlane separates data into distinct segments to ensure representation from underserved communities. This lets its models make predictions even when data is sparse for certain groups, a common problem in communities historically excluded from traditional credit markets. Greenlane also promotes risk-based loan sizing, where loan amounts are tailored to balance affordability and risk rather than simply rejecting applicants or assigning punitive interest rates. And because the AI automates many labor-intensive tasks, loans can be originated faster and cheaper than traditional methods, reducing the operational cost barrier that disproportionately affects smaller loans for lower-income borrowers. Humans still matter. Despite all this innovation, experts caution against fully replacing humans with machines. Lina Ju from the Urban Institute reminds us that AI should be an enabler, not a replacer. Human expertise is still critical, especially for oversight, ethical judgments, and quality control. Another key concern is automation bias, the tendency to trust machine output unquestioningly. When a machine makes a decision, humans are less likely to challenge it, even when it's wrong or unfair. This is why oversight, transparency, and human-in-the-loop governance are essential, especially when lives and financial futures are at stake. Who's responsible for fair AI in lending? One of the biggest challenges is regulation, and today, there's no clear federal guidance for designing AI systems to ensure fairness and prevent discrimination. In the past, government programs like those at Freddie Mac and Fannie Mae tried to promote inclusive data approaches. But recent policy shifts have rolled back some of those efforts, reducing federal focus on fairness initiatives. Without enforceable standards, much of the responsibility falls to individual lenders and state regulators. Some experts predict that states may take the lead in regulating AESATU fairness, especially in housing finance, a trend already seen in other AESATU regulatory areas. Meanwhile, federal agencies like the White House Office of Management and Budget recently issued policies requiring safeguards for civil rights and privacy in housing AIUs, but how these will be implemented remains unclear. The stakes, why this matters to everyone. This debate isn't just about technology, it's about whether AESATU will perpetuate inequality or help dismantle it. If fairness is prioritized in design, AESATU could expand access to credit, create more inclusive lending markets, and begin to heal the long tradition of exclusion in home ownership. If it isn't, then the mortgage industry may simply digitize discrimination, making it faster, more efficient, and more entrenched than ever before. And because housing is often the foundation of household wealth and stability, these decisions impact not just access to loans, but opportunities, generational wealth, and community growth. If you found this video insightful, be sure to like, comment, and subscribe for more deep dives into AI, finance, and social impact. Tell us in the comments, should AESATU be trusted to make fair decisions in important areas like housing? Or do humans still need to be in control? Thanks for watching and see you in the next video. AESATU is no longer just helping banks move faster. It's reshaping who gets access to home ownership. From mortgage approvals to interest rates, algorithms are now part of decisions that can change someone's life. Supporters believe AESATU can reduce human bias and create fairer lending systems. Critics argue it risks hiding discrimination behind neutral code. In this video, we break down how AI is being trained to tackle bias in the mortgage industry, what the data actually shows, and why transparency and accountability matter more than ever. If you're thinking about buying a home or care about fairness in financial systems, this is a conversation you can't afford to miss.